domestic markets, Indian GDP, what was expected was 6.77%, 6.5% was the expectation from the market in terms of GDP, whereas it delivered 5.4%. Uh, so even the last quarter we saw, it delivered 6.7%. So there is a slowdown, no denying on that. And this has been the lowest number which was recorded after 2022, because what was recorded during the COVID time, post that there was one more dip in 2022, and then the overall slowdown reflects. So there's no denying on the fact that the overall.
He's the founder and CEO of the company who will be telling about the market. Before that, I'll just give a short introduction about the processes and the products that we deal in. We deal with AIF product, PMS product, and mutual fund. So AI product is a high ticket size product for the ultra HNI clients, starting with minimum 1 crore. And in this, we have three categories: category 1, category 2, and category 3. Every category has a different asset class under it. So category 1, which is mostly investing in the early stage companies, which is like a startups, the companies are at a very early stage. And the category 2 is which invest in the pre-IPO company with their later stage, or they have an asset class as a real estate, or they have an asset class in some other. In category 3, it is pure equity. And in this, again, there is a further classification as long only, long short. Long only is 100% equity, and long short is an equity plus a derivative component. So these are the broad classification of the product in AIF. Similarly, we have a product in PMS. In PMS, there are many products based on the category. They are further classified as a large cap based on the underlying companies in which they invest in. There's a large cap and mid cap and small cap, small and micro cap, multi cap, multi asset, thematic. So these are the various class of PMS. So we cater in all these, and based on the client's profile, we suggest these products to the clients. And the important product is the financialism mutual fund, which is the biggest market in this. So we have our own proprietary tool where we analyze the portfolio of the client in mutual fund, and we give the insight on what need to be rectified in their portfolio to optimize the return. So this way we help our clients to gain the maximum insight and give the better performance in their investments. Now the agenda of this webinar is to give the market insight about the today's market, because the markets are volatile. And give me a time to introduce to Mr. Vikas Agarwal ji. Vikas Agarwal ji, founder and CEO of AIF PMS Expert India Private Limited. He has done his MBA from finance, and he also done a lot of courses in Flame University in Pune. He has more than 20 years of experience in the market in various companies, and he has been also appearing in the lot of TV shows like Z TV, Z Business, ET Now, ET channels. So he has interviewed more than 100 top minds in equity market to share his views and the insight from the market. So he's the best person to tell you about the market. So without wasting much more time, I would like to hand over to Mr. Vikas Agarwal ji. Over to you, sir.
Right. Thank you, Vijay. I hope I'm audible.
Yes, sir. Yes, completely
Okay.
audible.
Okay. So thank you, Vijay. I mean, and I would take this opportunity to welcome all the investors who have taken the time out from their busy schedule and made it today to this webinar. The idea is that now what we're doing is we have set up a separate research desk, which we call it product desk at AIF PMS Experts India. And Vijay is one of the important member who is heading the entire mutual fund research now with us. And apart from that, we also have Mr. Pradeep working with us for AIF and PMS research. So the whole idea is that while we are doing this research, we also track global markets and domestic markets. So we thought, why not? We'll take the initiative and start sharing this with our set of investors so that they are kind of aware about what's happening in the market, especially in the last 2, 3 months' time, we saw huge amount of volatility in the markets. So we've done some homework. So let me share the presentation, and then without any further ado, we'll start the conversation. So can you see my screen, Vijay?
Yes, sir, we can continue.
Okay, all right. So just go on mute. Uh, there's some disturbance coming from my end also. There's some work going on, so apologies for the same. Uh, so what we're gonna do is we're going to cover the global markets and of course the US markets. Uh, we'll try and understand what's happening out there because whatever happens in US 10 years down the line, it has we as an economy witness the same thing because we follow the trend. It's very important that we understand what's happening in US markets. Then we'll try and cover Indian macro factors, the equity markets. Our equity markets are broadly based on two parameters that we cover. One, the fundamental valuations, whether these valuations are justified or not. And second is we'll try and look at behaviorally, as in whether this behavioral valuation is justifying or not. And the third is we look at various valuation indicators, which we track at AIF and PMS Experts India. Our endeavor has always been to educate and empower the investor community as a whole. And me and my team is committed to put more efforts towards educating and empowering the investor community. At AIF and PMS Express India, we strongly believe that it's very important that we focus on asset allocation and build a very strong and high quality portfolio for our investors. And this study is nothing but an indication towards the journey that we are trying to achieve. So this is a global markets performance, particularly because last month we did one webinar on the markets, Vijay, if you remember. So in the last 1 month, what has changed is, if you look at between October to November data, US has gained about 5.7%. Although US markets are falling down, it's correcting in the last 11 days in the month of December, and this is happening after almost a decade. After 11 years, US market S&P 500 is witnessing continuous correction for 11 days, which has never happened in the last 11 years. But particularly last month, we saw 5.7% gain by US markets. Germany was up by 2.9%. UK was up by 2.2%. On the other side, Asian markets, most of these Asian markets are facing headwinds, as in Hong Kong markets, it fell down by 4.5%, followed by South Korea, which is down by 3.9%, and Japanese markets, which witnessed good amount of inflow in the month of October. Despite all that, in the month of November, it fell down by 2%. Whereas you look at India's Nifty 50 and Spain's IBX 35, both registered a modest decline because we already saw a major decline happening in September and October, and we'll be talking about that. So we did not see major correction in the month of so. So this trend, particularly the last month trend, is reflecting the resilience of Western markets vis-a-vis the Asian markets, but it's only for the month. Uh, yeah. So, 1 second. Can you see the chart here? Global market valuation. So this is a very important chart. We need to sort of understand that US markets they're trading at 26 ka P, and India happens to be the second expensive markets when you look at only from P perspective. Well, P is one of the parameters to look at. and not the only parameter. So from a PE perspective, when you look at India is trading at about 24 and a half. Australia is about 20. Now, what needs to be noticed here is your China is below the double digit P, which is below less than 10. And so is Brazil, which is about 7.5%. Uh, while it's a different subject altogether, whether India uh, justifies these kind of valuations, and we want to deep dive the whole valuation aspect. But this is what the broadly numbers looks like. Now, this is the global market valuations, as I just talked about it. Uh, but when you look at last 10 years of average, this data gives you some idea about last 10 years of average P of the markets. When you look at China, it is at about 11%. So historically, also last 10 years, last 20 years even, historically, they were at about 11 to 13, 11 to 13. This is the average number. So whereas when you compare that with the US, because these are the only three countries that one would remember, US, China, and India, which is creating its own mark. So US is about last 10 years is about 18 and a half, last 20 years is about 16. But particularly as we speak today, this is trading at 26, 26 and a half copy. And what we saw is that even post COVID, we saw that the US was inching up towards 21, 22 copy. Now let's look at India. Last 10 years, average market P is about 20, around 19 and a half and 20. And currently we are trading at about 25, 24 and a half. And there are reasons behind it. And we will share that with you also in the subsequent slide. Then US policy rate, this is a very important thing to keep a track of it. What we saw is that interest rate, this is the third consecutive rate cut since the easing cycle began in September 24. So what we are seeing is that after Trump coming in, he's going to take over now. The trade war has begun across the globe, and I'm sure all of you are reading in the newspaper. He's very vocal about putting duties and tariffs to country like China. Even he's vocal about India also, that India always focus on self consumption and do not allow US companies to function well. And he's already started talking about it because for him it is US first. And what we are witnessing is that there is a rate cut also, which is 25 bps. So globally, when you look at the inflation numbers are cooling off, but what is more what is more concerning is the debt size of the globe, which is at $300 trillion, uh, vis-a-vis your total GDP size of the globe, which is about, I think, 96 to $100 trillion. So 1:3 ka ratio, which looks to be on higher side. So trade war has begun. Inflation is cooling off. Your US particularly has a debt of $36 trillion today, and every $100 that they make, the kind of GDP they get out of $100 is only 0.58. So they are able to produce 0.558% of the GDP against the dollar, 100 rupees of dollar they print. That is another worry, and therefore the overall debt of the economy is going up, and this has happened in both the leaders' guidance, as in even when Mr. Biden was the president of US, the economy witnessed highest record high debt, and we don't see that even after Trump taking over, this is going to slow down. So that's another worry. Uh, Now coming back to going to the next slide, the other thing is that after this U.S. election, the dollar index rose sharply, and this is reaching at almost 2 years high. So dollar is strengthening. Even rupee has seen some amount of depreciation. It is now reaching to about 84.7 levels. Um, I think a lot of strengthening the dollar and weakening the rupee has almost done now, and we believe that it is going to stable. What are the reasons for this dollar to strengthen? Because dollar benefits from a resilient U.S. economy. There, 50% of the population has invested in the share markets, and if share market slows down, the consumption will slow down. So, as a president, Mr. Trump would never allow share market to sort of come down or get neutralized, and therefore they put a lot of efforts towards this. The other thing is the investor sentiments. We saw what happened in September, October is that because of the elections, there was a major selling happening in the emerging markets, and those mandates which were given to emerging markets moved to US markets, and they made money also because they were expecting markets to do well. So their investment sentiment, investor sentiments is good. The economy is benefiting from the overall outpacing the global growth. The Fed hawkish stance, the increase reflects market expectation of sustained high interest rates by Federal Reserve to combat inflation. Because inflation is another concern in US, and while they are able to manage it, but it's still on a higher end. That's about 4.25% now in terms of numbers. Uh, yeah. So we've already covered this. This is Indian economy indicator GDP. So let's come back to what's happening in domestic markets. Um, Domestic markets, Indian GDP, what was expected was 6.7%, 6.5%. It was the expectation from the market in terms of GDP, whereas it delivered 5.4%. Uh, so even the last quarter we saw, it delivered 6.7%. So there is a slowdown, no denying on that. And this has been the lowest number which was recorded after 2022. Because what was recorded during the COVID time, post that there was one more dip in 2022, and then the overall slowdown reflects. So there's no denying on the fact that the overall the numbers have come down, but the GDP growth has come down across the globe. This is not the only country where GDP has slowed down, particularly the last 2 quarters. Of course, our market has our own reasons. One of the reasons is that government capex. What they decided initially is to spend 11.11 a lakh crores, and what they could manage to spend was only 4.5 lakh crores. So in the first half of the year, um, not even 35% of the total mandate that they've decided. तो अगर गवर्नमेंट कैपेक्स नहीं लेगा तो ऑब्वियसली स्लो डाउन आएगा. And they were busy in their elections. We saw what happened in Maharashtra, Haryana. They were busy in elections. Plus, they wanted to ensure that the direct collections are. They wanted to basically watch out for what's happening on the direct taxes, because the corporate taxes have come down. The GST collection is below the nominal GDP growth. So nominal GDP growth is your inflation plus your actual growth. So your actual growth in the last 2 quarter, the average is about 6%, and your 5% around, 6% is about inflation. So put together, it is about 10.8, 10.9. total the nominal GDP growth, and the GST collection happening in India is lower than the nominal GDP growth. So that is also a sign of slowdown. Uh, but India continues to be the world's fastest growing major economy. People are saying that it's a growth engine for the entire globe. One can't forget that, despite this number slowing down. So this itself is a remarkable achievement. Um, uh, we believe that going ahead, what has happened in the last 6 months is we believe that the worst is behind us, because this time जो फसल हुई है हमारे यहाँ खरीफ की, that फसल is one of the strongest in the last 10 years. The water levels are above the last 10 years average water level in India, and the rural economy is outpacing the urban economy of India, as in the urban cities. We are witnessing good growth numbers coming from rural economy, as in when you look at two-wheeler sales. How do you measure this? Because when you see two-wheeler sales, three-wheeler sales in these areas, you get to see that clearly it is doing very well. The festive season was very good. What we are witnessing is, I'm sure you're getting invitation for the wedding, so there are 50 lakh, more than 50 lakhs weddings which have been planned in the next 2 3 months time. So we believe that because of that, the spending power will increase. The government will try its best to achieve its target of 11.11 lakh crores. So the capex has already begun. They are fast tracking it, and there is an opportunity right now, because Trump taking over going to put too much of tariff on China, and India has an advantage to create China one story and be a part of the global supply. So you will see major uptick coming in, and all said and done, um, everything is now reflecting in the price, because you saw September, October, you saw FPIs taking out the money, and I'll talk about that in my next slide. So India's strong economic growth. This is the data that I picked up when I tried comparing this with last 10 years, and then we want to see what can happen in the next 5 years. What is expected, because RBI has revised the expectation of the GDP from 6.7% to 6.5% now. Uh, and inflation is a concern there, because inflation is going up in India. That's another concern. But we tried doing some sort of analysis, as in how was the last 10 years, and with the expected projection done by RBI and the various large institutions, how it is looking like. So in the last decade, it was 5.7%. Next 5 years, India looks to be growing at 6.3%, which is by far is the highest. Second is China. So China is slowing down clearly, and what they could deliver in terms of GDP in the last decade, uh, we'll find it very, very difficult to deliver those numbers. What is projected is about 3.9% vis-a-vis the last 10 years, which was at 5.9%. So when you compare this with other economies, you have Indonesia, China, Saudi Arabia, Tokyo, Korea. I mean, clearly, well, India cannot be compared with these countries except for China and US, to my mind. But this is just a data. So what we are saying is the strong economic growth, consistent growth momentum. Momentum has built up. When I say momentum, what do you mean by momentum? As in, when you look at the capacity utilization is at all time high. We say that we don't get people. People say that we don't get jobs. But those who are running businesses like me can say that they don't get quality people to work with. So this gap clearly indicates that there is enough job, and the economy is shaping up very well. Economy is showing resilience. When I say resilience, as in despite so many wars happening across the globe, We saw what happened in the last 10 years. We saw Ukraine war. We saw what happened in Israel. We saw global meltdowns happening. But India continues to grow. India has grown at 5.7% the last 10 years and will continue to grow even more higher than last 10 years. Uh, and what is more important is this time that China's economic growth has been more subdued. This is the reflection. So India has an opportunity to leverage on this. Uh, this is the number. This is another. This is the concern. If you ask me, what is the risk, because in the markets now? So one of the risk is the inflation rate. Inflation, particularly in October, jumped up to the tune of 6.21%, which is highest so far in the last 12 months. This is much beyond the expectation. The expectation broadly was at about 5.8%, because that's the average number which comes out in the last 12 months. And why it has gone up is because of the food inflation. The food inflation went up like anything in the month of October because of one, the festive season, because of two, we had uh, very strong summer and then heavy monsoons. And during the monsoons, we saw uh, these agriculture farmers, they were struggling to produce crops, and as a result of that, we saw suddenly the food inflation going up. But what is targeted by RBI is about 4%. So according to them, it's still it is much higher than their expectation, which is about 2.21%, almost 55%. So that's how it is. And how do you tackle this situation? So RBI, although took a stand of not changing the repo rate, um, and this was the 11th meeting in the month of December, and they held at 6.5% the repo rate. Policy stance of the Indian economy, you know how RBI, how conservative they are, and how closely they work with Ministry of Finance, and they continue to have neutral stance amid they are witnessing and they are admitting there is a slowdown in the economy. And to tackle this situation, they decided that they will reduce 50 beeps of CRR. Now, what is CRR? Is cash reserve ratio. So, like if you're running a bank and if you're accepting deposits and you are giving loan against that, then these banks are supposed to maintain 4% of liquidity at all point of time. Now this has been reduced by 50 pips. So they said they told all the banks that instead of keeping 4.5%, you keep it at 4%, and this liquidity will further go into the markets and then will help economy to produce higher GDP and reduce the inflation. So this is how they've tackled the situation. As far as Indian equity market outlook is concerned, these are broad indices. Your large cap, mid cap, small cap, as even despite markets correcting in the month of September and October, net when you look at last 1 year return for large cap is about 21%, and last 5 years is about 16%, whereas mid cap is about 31%, and last 5 years is about 28%. Then the small cap is 30% last 5 years, and last 1 year is 34%. Now, this is one area where I want to make all my investors be little more realistic about the market, is that these kind of extraordinary returns which have been delivered by Indian equity markets may consolidate, as in there will be a mean to revision, and you should have right expectation from the markets that small cap will not continue to deliver these kind of extraordinary returns forever. there will be consolidation in the markets. Many congratulations to all of you who invested, particularly our investors, set of investors who have invested in small cap PMSs, AIFs, and some of the mutual funds. But please don't expect these kind of extraordinary returns. It may consolidate. Now, this is the interesting side. People talk about FIIs, the FPI's outflow. But let's look at these outflows and then look at, um, you know, compare that with last 10, 15 years of data points. So what we saw is that in 2018, they had taken out $4,500 million. And that is a time, 2018, if you remember, we had demonetization and we had a couple of other major economic reforms like RERA was implemented, GST was implemented, we had demon. So all that has happened. That was a time when they withdrew money. Otherwise, you look at 15, 16, they were net buyers. 19, they were net buyers. 2020, they pumped in almost $23,000 million. 22, they started withdrawing. 23, they again got back to positive. And then 24 onwards, when you look at monthly numbers, so you see that in the month of October, this was the highest sell done by FPIs in India. And they did not sell India particularly, they were selling the entire emerging markets, close to $10,000 million, almost $13 billion, which is about almost more, 1 lakh crores. Uh, so, but on the other side, when you look at, uh, this is the number that I'll show you. This is the numbers in crores. So, as I said, the October we saw 94,000 crores of net sale. So let's look at from January because they follow calendar year and not financial year. So January we saw minus 25,000 crores equity. February little bit of positive, March positive, April negative. But the total is, when you look at the 24, because they have been taking the money out, overall there has been major outflow in the month of October. But good thing is that in the month of December, what we are witnessing is that they're coming back. They've already deployed close to $3 billion as we speak in the last 15 days, despite US markets correcting. On the debt side, what we are witnessing is there has been continuous inflow coming from FPIs. Indian debt markets are becoming a global debt market, not to forget that. And this is happening for the first time that what we are witnessing is huge inflow coming on the debt side. That this debt money will give you more strength as an economy to grow because this money goes towards expansion of the economy. So this is a healthy sign. So equity trend we already discussed. There's a fluctuation. Debt we already talked about. The strong inflow of 1,11,554 crores of inflow. So far, this is very good. The total equity inflow for the year was modest. So this is the only year where we saw only 7,500 crores of inflow. Now, not to forget that overall it is still in positive, 7,500 crores so far, the net inflow on the equity side, although it's a very small, minuscule number. And what is more important is that I'll show you in the next slide, what percentage they have taken money out. On the AIF PMS mutual fund side, AIF PMS instruments recorded most noticeable activity in terms of inflow. Now, thanks to our Indian investors, particularly HNIs investors and ultra HNI investors, over a period of time, by virtue of market cap, by virtue of their own experience with equity as an asset class, they became more confident about this asset class. and they did not react to the situation. And while the FPIs were taking the money out, they continued to invest. And particularly AIF and PMS witnessed huge amount of inflow. Both AIF industry is at about 3 lakh crores. PMS is about 3 lakh crores now. And mutual fund, is at about 65 lakh crores. Record, all time record. SIP numbers have gone up to 20,000 crores. So a month on month, we are witnessing more than 20,000 crores of inflow coming from mutual fund managers in the form of SIPs. And not to forget, this SIP money is a sticky money. It comes for next 5, 10 years. Nobody starts the SIP and very next month they stop. No, if they start, they come here for 5 years, 10 years with a particular goal in their mind. So this kind of sticky money is helping the economy to sustain the valuations, because if if this 1 lakh crores would have gone out 5 years back before COVID, your markets would have at least come down by 20-25%. And this has happened in the past also. COVID was one example. We're going to cover that in the next slide. So, of course, the volatility has gone up, but overall, in summary, when you look at the net FPI inflows in 2024 were primarily driven by strong investment in the debt side. I already talked about it. While the equity was minuscule, but still in positive. Now let's go back and look at what has happened when these FPIs took their money out and went back to their own countries. Now let's look at the major events. So we saw first event. I remember this was Lehman Brothers crisis. It is called. Some people call it global financial crisis. That was a time between January to March, almost for 5, 6 months. Uh, they've taken the money out from the market cap perspective, was almost 15 billion dollar. You know, that was the highest during that time. And outflow of what is more important here, what you need to see is that $15 billion that point of time was 1.5% of the market cap. And this time when they've taken 12 and almost $13 billion out so far. This is only 0.03% of the market cap. Now, this clearly indicates that we are not completely dependent on FPIs anymore, and their overall weightage of the MSCI index, despite it is coming down from 19.5%. I mean, their weight to India at MSCI index is about 19.5. Has come down to now 16.5. But nothing much happened. And let's go back when markets fell down from the peak through 66%. In the very next year, it delivered 127% returns. This is BSC 500. So it's a broad index, has very good variety of companies. Then second time it happened, this was 2015-16. Some of you maybe remember what happened in the global economy. Yuan started devaluating. And then we saw markets going down by good 16%. And very next year, it was up by 32%. Same what happened in recent time, which is COVID 2020. Market fell down by 37%. I hope some of you joined here for the first time or have been in the markets for last 4 or 5 years may remember as your first global event. Because for me, this was, I think, sixth event, because I saw dot-com bubbles, then I saw Lehman Brothers crisis, then I saw 2015-16, then I saw Fed hike, then I saw 2018-19 when it was a major slowdown in India, and then I saw COVID, and then the recent one which is going on. So this chart reflects that whenever market corrects, and this time it has corrected by almost 10% now as we speak, because of last 3-4 days of correction. But despite all that, we are, let's see where do we reach. My sense is that uh, these numbers would surprise on both the sides. Because why do I say that it can surprise us much higher than what happened in 2021? Because the overall FPI's allocation to India is at the lowest point of the last 10 years. This is the valuation analysis. And imagine if they start deploying money, they start coming back. We already saw December, they started buying Indian equities despite valuation. So let's look at the valuation. So next 1 year Nifty looks the average last 10 years of P market P is at about 20.5, sorry, 18 and a half, and currently it is at 20.5. So you have almost 10% of premium, particularly Nifty, more towards large cap. But when you look at mid and small cap, the valuations looks to be little stretched, as in particularly mid cap is trading uh, at 30.7 P. Uh, so I would like to give you a sort of reminder to all my investors that I would suggest you to be a little more conscious about investing in mid cap anymore. In fact, if you have some money, we are suggesting them to book some profits and come out and move towards large cap. The large cap looks much better. I'll show you in the next slide. And small cap is at about 24, but here we are not so much worried because now one, the base is very broad, the small cap base. Second is historical numbers not to be looked at here, because particularly in the last decade we did not see economies doing well, and these small companies were not doing so well. But post COVID, it started doing well. So we suggest everyone to consider investing in small cap. Uh, Everybody talks about, is this valuation justified? Uh, I would say yes. And the reason is, when you compare, now how do you come to a valuation? Now, valuation, there is a saying that your markets are nothing but slaves of the earnings. And when you look at Nifty EPS growth, and when you look at compare that with P in the last 4 years, what we are witnessing is that the corporate profitability to GDP is 1:1, which means that if your markets are going, so is your earnings. And as long as you have continued to see these earnings, you don't have to worry about the valuations. So strong earning growth justify the premium valuations. And there is one more reason behind it, that all the bad performing companies have started going out from the benchmark, and all the good quality companies are entering in. And therefore, obviously, when you have these good quality companies, obviously it will be expensive. And when it will be expensive, then the overall P level of the benchmark also goes up. So market is confident about sustained growth, sectorial strength, and economic resilience. We already talked about it. We did not see any issues as far as IT market is concerned of India, or pharmaceutical industry of India. And obviously, there is a premium for growth, but investors are ready to accept and ready to pay because of this growth. If this growth would have not been there, then one can say that there is a froth in the market. So I talked about this market cap to GDP ratio. Well, this is at all-time high, 132%. Of course, uh, much above than the last 10 years of average, which is at about 85% of the market cap to GDP. What is market cap to GDP is basically what is the size of your economy and what is the market cap of the entire companies which are listed in both BSE and SE put together. What is the total market cap? That. Now, market confidence. So high ratio reflects that investors' confidence is very high. That is why it is at 132%. Now, there are parameters which is this, like this is the parameter which is mainly used by Berkshire Hathaway's president, Mr. Warren Buffett. He says that it generally should be 1:1. But we would say that if the economy is growing, then obviously you have to look at what is this the new normal, because what has not happened in the last 10 years actually happened in India post COVID. Because post COVID, as I said, your earnings to your market growth is 1:1. Because last 10 years were flattish in terms of growth, therefore it cannot match this 132% cannot come down to 85% anymore. But what is the risk involved? Some investors they keep asking me, because what risk do you see? We see two major risks. One is the inflation number, and second is unemployment numbers. That looks to be on higher side even in India. So this is the concern that India economy has at this point of time. I was referring to this chart, by the way, that you see post COVID, the market cap in terms of this is a trillion dollar number has delivered 241%. And when you look at the profit after tax, and this happened because the Indian government took this major reforms of slashing down the rates from 32% to 25%, because they wanted Indian corporates to grow. And you see their profit after tax is at 257%. When you look at the market cap is at 84%, and suddenly you saw rise in market cap. But when you look at the profit tax, particularly pool, which was 26% of the economy, market cap to PAT, and market cap to GDP also, when you look at the another ratio, then also you realize that when it was peaked out at 7% in 2007, from 7%, the market cap to GDP, the corporate profit to GDP came down from 7% to as low as 1.8% till 2020. And from there, it turned around. And from 2020, what we are witnessing is that it is coming back to almost 4.5%, 5% now. So this clearly indicates that the PAT growth, the market cap growth, both are at 1:1 ka ratio, which is a very good healthy sign. Now you understood why did I say that? Uh, why did I say that it cannot come to 85%? Because your historical numbers were very poor, and this is the new normal, to my mind. So sorry for taking you to the previous slide. Now this is the fair gauge. All of you know VIX. It's a volatility index. Because of the volatility spiked up because of two reasons. One, the uh, RBI, they were expecting the rate cuts, the inflation numbers are going up, and the economy slowing down, the weakening economic growth. Market started witnessing huge amount of volatility, and therefore the VIX was going up. Um, it was hovered around 14, a relatively moderate range, I would say, but still above the typical lower levels which was seen in the earlier period. So obviously, when you have these kind of concern, then obviously it goes up. Uh, this is RSI indicator, so it reflects that there is a good amount of opportunities in the large cap space, because your large cap to mid cap RSI is at record high valuation. So we just saw large caps were trading at 20.5 to 21, whereas the mid and small cap, they were at 30 and 26. So obviously, your large cap space looks more attractive if you are investing from 2 to 3 years point of view. But if your horizon is more than 10 years, then one should not look at this as one of the parameters. This is Indian equity investment indicator. So it says that fundamentally we are moving towards positive side. Valuation looks to be neutral. It is not cheap and it is not expensive also. It's slightly towards expensive, getting into an expensive zone, particularly mid and small cap. But when you look at large cap, by far this is very close to almost a gap of only 10% to the last 10 years of average. I just told you the last 10 years average is about 18 and a half P, and your current large cap P is at about 20. Sentiments is very positive in India. I talked about it. I gave you the indication about the utilization level, the manufacturing, the way it is shaping up, the service industry, the way it is going, the rural economy is outpacing the urban cities. So sentiments looks very good. Everybody is positive about India. Even globally, India is gaining a lot of respect, and the market trend is bit neutral, not negative, not positive, because of what happened in the in terms of outflow of the FPIs. But despite all that, I would say that to summarize, I would say that worst is behind us. In the second half of the economy should pick up. The government capex will go up, uh, and the slowdown will improve, and we would see some improvement happening in the second half of the year. As far as economy is concerned, uh, while to reflect the same, it might take at least 3 months to 6 months time to reflect in the share market the same thing. So I would suggest that when you are deploying fresh money, uh, take the route of STP, which is systematic transfer plan, put the money in liquid fund, and then start moving towards equity. With that, I'll conclude my remarks here. Thank you so much for
Yeah.
giving us your patient hearing, and we'll continue to come every month and share our perspective about market. So, thank you so much.
Thank you, Vikas, sir, for your valuable insight on the market. And we will also take questions if any of the attendee wanted to have.